Good day, friends. Today we will discuss valuation of a hotel project, how you can do the valuation of a hotel as per profit method. And CEV welcome you for watching this video. Please do not forget to like, comment, and subscribe our registered valuers club for getting all new professional videos. And please watch this video till end so that you are able to get inside knowledge of how to do the valuation. We will be doing two examples which will make the things clear how the valuation of the hotel can be done with the help of profit method and when the help of discount cash flow method. So we will discuss two methods in this video. First we will discuss about the basic theory part of this valuation of hotels and what are the things which you have to consider and how they have to be dealt with. So this video we will discuss what is hotels valuation basically. So how it is done. A hotel's value hinges on its ability to generate profit from the hospitalities. You know the hotels are basically deal dealing with hospitality, and here we will have to find out the profit which is generated from this business. So basically hotels are licensed premises, and they have to adhere to strict regulations. So the valuation process differs based upon the whether the owner operates the hotel or a tenant pays the fixed rent. So there will be two situations, in one when the owner is operating the hotel and the other is that the tenant is operating the hotel and he is paying a fixed rent. So owner operated hotels require special valuation considering factors like location, amenities and management, and whereas tenant run hotels are valued similarity to the ordinary rented properties. So what are the key factors which influence hotel valuations? So basically commercial hotels, they deal with the accommodation business for travelers, leading to lower occupancy on weekends. And if they are provided with the modern amenities just like lifts or elevators, so these are very essential. So where these are available for with hotels with three or more floors, they will be attracting elderly or disabled guests, and this will lead to more clientele and more profit to the owner. And this thing, ideal location. So location is very important. If it is located in a quiet atmosphere with easy access to the shopping centers and amenities, it will attract more clients. And if proper parking facilities are available, they are very crucial for city center hotels, impacting accessibility and guest convenience. So these are certain factors which affect the hotel valuation. Then upon importance of management and accommodation. So this is very important. Management part of this of a hotel is very important. So management, if the management, good management maximizes the resources, run efficiently with the minimal staff, and ensures quality service. Poor management leads to decreased receipts due to poor meal and service. So this thing also affect the profit from the business and thereby affecting the valuation of the hotel. Similarly, occupancy rate, if the occupancy rate is higher, it directly increases the hotel's value, reflecting its popularity and profitability. And then most important thing is standard of accommodation. With the standard of accommodation, it includes amenities like hot water, air conditioning, and attached toilets positively affect the value. If it is provided with all modern amenities, it will attract more clients and thereby increasing the profit and value of the hotel. So what are the financial aspects of a hotel valuation? First thing you have to find out gross receipt. What is gross receipt basically? Gross receipt is total income received from customers during a particular year. That is gross receipt. And gross profit is gross received minus cost of food stuff purchases. So there is difference between gross receipt and gross profit. And then the third thing, gross income. So see here, there are three things. One is gross receipt, other is gross profit, and third one is gross income. Gross income is gross profit minus working expenses. That is gross income. And then net income. Net income is gross income minus outgoings. So there are four things which are important from valuation point of view of a hotel. First thing is gross receipt. From gross receipt to deduct the cost of food stuff purchases, that of daily use material. The cost of daily use material has to be deducted to get gross profit. From the gross profit you deduct working expenses, that will give you gross income, and from the gross income you minus outgoings, that will give you net income. So it is a net income which will be used for calculating the value of a hotel. So what are working expenses? Working expenses are essential for the smooth operation of a hotel. These includes interest on working capital. See here, what are the things which are to be added in or considered in working expenses? First thing is interest on working capital. Second, staff salaries, telephone and postage, stationery, advertisement, electrical consumptions, lift maintenance, laundry expenses, staff uniform, and miscellaneous costs. These costs which are associated with the working of the hotel, they are called working expenses. So these working expenses include these things which we have discussed now. So efficient management is key to controlling these expenses. Lower the expenses, higher will be the profit. But staff costs often constitute major portion, including salaries, provident fund, gratuity, and bonus for managers, clerks, accountants, and other staff. So this thing is very important for doing valuation. That what are working expenses which are to be considered in the valuation of a hotel. So these are basically if you are not able to calculate the working expenses from the balance sheet, these are the generally expected percentages for working expenses. So these are not actual, these are just thumb rules which you can use for calculating the working expenses. For example, for interest on capital borrowed 3%, staff employed 18%, telephone and post 3%, stationery 1%, advertisement 2%, electrical consumption 5%, lift is 1%, laundry expenses 3%, staff uniform 1%, miscellaneous 3%, and total approximately 40%. So this percent, yeah, this is these are generally general guidelines, and you can adjust the percentage based upon specific circumstances. These are just guidelines, not actual. Then outgoings and net income. So what are outgoings and what is net income? Outgoings, what are the things which are to be included in outgoings? Outgoings include municipal taxes, insurance premium, ground rent, repairs, maintenance, and management collection costs. These are the things which are to be considered in outgoings. So provisions must be made also made for owners' remunerations, reflecting their role in running the business and generating profit. So net income. So what is net income? Net income is a residual income after deducting the outgoings from the gross income. So this figure is crucial for determining the property's value through capitalization. So how the capitalization rate is determined. So we will discuss it in capitalization and risk assessment. So capitalization rate in this case, capitalization rate is of interest used for capitalization is directly proportional to the risk involved in recovering the income. So this is the basic thing how you have to calculate the capitalization rate. So in in case of running hotels, it involves risk and speculations with strict license provisions requiring constant vigilance. So, how you can calculate capitalization rate in this case? You can do or adopt a rate of interest commensurate with the similar types of investment. So, you can assume the rate depending or considering similar type of investment, and you can do certain adjustment in that to make it suitable for a particular case. So in this way you can. Now we will discuss discounted cash flow method for hotels. So it is one of the methods which is being used for calculation of valuation of the hotels. So this method predicts a hotel's future cash flow. It adjusts for risk and the time value of the money. So how we do here? First of all, we calculate the projecting future cash flow for 5 to 10 years. Then this future cash flow is based upon the room pricing as well as operating cost and occupancy of the hotel. So based upon occupancy, room pricing and operating cost, we calculate the predicted annual earning for over 5 to 10 years. Then from this projected cash flow is converted into present value by selecting a discount rate. So how this discount rate is calculated or assumed? It is calculated or assumed on the basis of weighted average cost capital of the hotel, so which reflects the investors' expectations. So for this WACC, we make certain adjustment based upon the future cash flows, risk, and account for the time value of the money. We make certain risk adjustments in this WACC, and then we select that rate, and it will be different for different situations. So we cannot use the same rate for different hotels. Then we convert the predicted future cash flows into present value by using discount method which we used for valuation of such type of property. Then how it is done? We will calculate the present value by discounting future cash flows, and then for each year cash using discount rate, and that will give you the value of the future cash flow, which will be called the money today. So money today is worth more than the money in the future, we know. So we calculate the present value of all the future cash flows by discounting all the future cash flows by using WACC percentage. Then we know that even after 5 to 10 years, it is not that the income from the hotel will stop. It will continue to generate income for a number of years. So there are two situations. One is that income will be perpetuity. So we will assume a perpetuity growth model in that case where the cash flows grow steadily. And there may be that after the future cash flow or 5 to 10 years, the hotel is to be sold, and that for that we will be using exit multiple in that case if the hotel is sold at the forecast end. So what we will do, we will is calculate the discount value of the terminal value by applying the discount rate, we will be using the same discount rate which we have been using for calculating the present value of all future cash flows, and that discount terminal value will reflect the terminal values worth today. So then we will calculate the total value of the hotel by adding the present value of the projected cash flow and discounted value of the terminal value, that will give you the total value of the hotel. So in this way we can calculate the value of a hotel by using discount cash flow method. So what are the benefits of this discount cash flow method? It assumes steady earnings. So by using the occupancy rates and room pricing, we will be calculating the future cash flows, and then we will discount them to calculate the present value. So this method has benefit that it will be used full for the hotels with steady earnings. So now we will move further for some examples based upon discount cash flow methods to calculate how to calculate the value of a hotel by using discount cash flow method. Now we will discuss certain examples. First, we will discuss the example based upon the discount cash flow method. So let us suppose the data is given that a hotel expects to generate rupees 20 lakh per year in cash flow for the next 5 years. Hotel's weighted average capital cost is 9%. Assume the hotel will be sold at the end of forecast period. EBITDA means earnings before interest, taxes, depreciation and amortization in final forecast year, means in the last year, fifth year, is rupees 25 lakh, and similar hotels sell for 8 times EBITDA. So calculate the value of the hotels. So hotels WACC is given to you as 9%. So we will use this rate to calculate the discounted cash flow for the next 5. So you know what we have to do. First year's income 20 lakh, it will be divided by 9%, means 1 plus r raised to power n. Present value factor is 1 over 1 plus r raised to power n, means divided by 1.09 raised to power 1. Then in the second year, 20 lakh divided by 1.09 raised to power 2. In the third year, 20 lakh divided by 1.09 raised to power 3. In the fourth year, 20 lakh divided by 1.09 raised to power 4. In the fifth year, 20 lakh divided by 1.09 raised to power 5. And if you add all these, it will come out to be 77 lakh 79,302. And see here, since the amount is same 20 lakh every year, you can use the present value or YP method for calculating this value. You can use YP single rate. For that you can use Excel. In Excel you generally put the values in present value. 9% is the rate, NPE number of years is 5, amount is future present value, payment is 20 lakh, 0. You put all these values, you will again get this value as 77 lakh 79,302 from the Excel directly. You need not to do any calculation, you can do it easily in the Excel format. And then future forecast, IBDT is given to US 25 lakh, and it is given that similar hotel sell for 8 times this ITDA. So your terminal value will be 25 lakh into T, that is 2 crore. And now you have to calculate the present value of this 2 crore. So present value of 2 crore, you divide it with the present value factor, again using same discount rate which is 9%. So 2 crore divided by 1.09 divided by 5, that will give you the present value of 2 crore, that is 1 crore 29 lakh 98,627. So you can also calculate the value by using this. Simply put all the values in the present value. In Excel you will get the same result. So you calculate, add the both the values, present value of all the future cash flows and the present value of terminal value. Add both of them, that will give you the total value, that is 2 crore 7,77,930, means approximately 2 crore 7,78,000. Another example, a hotel is constructed on a freehold plot of land at varying 1248 square meter in the heart of a town. The gross received during a particular year works out to be rupees 41,59,400. The owner has to spend 13,59,400 for the purchase of food and stuff items. If the owner has to pay an amount of 1,74,520 towards the insurance premium, taxes, etc., and usual outgoings are 22%, calculate the value of the property. So, see here, gross receipt is given to you as 41 lakh. This is gross receipt 41 lakh 59,400, and then amount he has to spend for purchasing foods of items of daily use, food stuff, etc. That is 13 lakh 59,400. So gross profit of the owner will be, you deduct 13 lakh 59,400 from 41 lakh 59,400, so it will be 28 lakh. So working expenses is given to you as 40%. So 40% of the gross profit, that will give you gross income. So gross income 40% of 28 lakh, it is 11 lakh 20,000. So gross income of the owner will be 16 lakh 80,000. 20 lakh minus 11 lakh 20,000. So 16 lakh 80,000 is gross income. So other things they are given to you as a insurance premium, municipal taxes, etc., which is given to you as 1,74,500. So you deduct this, that will give you 15,05,480. Then usual outgoings are given at 22%. So 22% of gross income, that is gross income 15 lakh, and 22% of it will be 3,31,205. So net income will be 11,74,274. So capitalization rate is going to be at 12%. So you capitalize this at perpetuity. So it will come out to be 100 upon 12. UIP perpetual is 100 upon 12. So it is 8.33 multiplied by the net income, that is value of the hotel is 97,81,000 approximately. Now we will discuss certain MCQ based upon this video. What is gross receipt and gross income in the case of valuation, hotel valuation, whether they are same, they are different, may have equal value, do not have any relevance in valuation. So you know gross receipt is the total income which is received, and gross income is not equals to gross receipt, so they are different. Gross receipt and gross receipt. Second is gross profit in a hotel valuation. Gross receipt. What is gross receipt in valuation? Hotel valuation. Gross receipt minus amount spent on purchase of various types of food stuff. Gross profit is, what is gross profit? Gross profit is gross receipt minus amount spent on the purchase of various types of food stuff. Gross receipt plus amount spent upon purchase of various types of food stuff. Gross income minus amount spent on purchase of various types of foodstuffs, or gross income plus amount spent on purchase of various types of foodstuff. So what is gross profit? Out of these four you have to give the answer. Then what is net profit? It is gross profit minus usual outgoing, or gross profit plus usual outgoings, gross income minus usual outgoings, or gross income plus usual outgoings. You have to give the correct answer. So the rate of interest to be adopted for capitalization of an income in a total valuation is directly proportional to the risk involved in procuring the income, indirectly proportional to the risk involved in procuring the income, do not have any relation to the risk involved in procuring the income, or the risk involved in procuring the income may be ignored. Which is the correct answer you have to give. Then discount cash flow method predicts how much cash a hotel will make in the future and adjust the risk and time value of the money. Do not predict how much cash of a hotel will make in the future and adjust for risk and the time value of money. Has no relation with how much cash a hotel will make in the future or adjust for the risk and time value of the money. Do not have any relevance in discount cash flow method. So answer first, sorry, this answer is B and all other answers are A. So